Welcome back, everyone. This is Thomas Triple T Tie with another new bullish crypto analysis. Before we dig in, please remember if you find value in this video, feel free to smash the like and ring my bell and hit subscribe and leave a comment in my YouTube comment section. Let's dig in and take a look at an indicator that may help you anticipate the future prices for Bitcoin. Let me get my highlighter turned on. This is trading view on 1 week on the weekly chart, and the indicator we're looking at here is called spot to derivative basis. There are a few of these on the TradingView community script marketplace. This one is closed source, so I don't know what the source code looks like, but I'm gonna guess. There are other ones that are paid, but they work similarly, and there are other ones. There's another one that's open, but it's not as good in my opinion. So how do you find this indicator? So first you go to click on indicators, and you want to look for you type in spot derivative basis delta. Spot derivative basis delta. I think it might be this one. Yeah. So yeah, just look for start typing spot derivative, and then you look for the one that pop up. I already made it a favorite, so you have the yellow star, orange star here, but it's by Truenomics, and with 373 subscriber to this script. So once you have it, you double click on it, and it will appear at the bottom of your chart. Again, that's spot and derivative basis. Spot derivatives basis by Truenomics with 373 subscribers. So once you have that down here, I'll walk you through it. So first of all, let's define some words. Spot means spot market, which is the normal marketplace where you buy your cryptos, such as Binance US, Coinbase Pro, Coinbase, KuCoin, etc. That's what the spot market is. But they also have futures markets there too. But it's the place where you buy regular Bitcoins and Ethereum, etc. So that's what spot market is. Derivative basis delta. Delta means the difference between one variable to the next one. So if I say the delta between 4 and 2, it would be 2, because 4 minus 2 equals 2. So derivative in this case is basically perpetual futures, and that's a type of future contract that goes on and on and on and renews typically every 8 hours. I have links for futures information if you want them. The basis means the difference between. So, like if you take the price of a perpetual, like Bitcoin's perpetual futures price, and you subtract that, you subtract the spot price from that, then you have the basis difference between the two. That's the basis delta. So it's a lot of words, and if you're confused, that's okay. It's normal, but it takes time to learn. So how do you read this? So basically, when it's negative, where it's white here, that means that the spot price spot prices are trading at a premium, meaning that the spot prices are larger or bigger than the perpetual futures prices, right? So that's why it's negative. So you take the I'm gonna say perps from now on because there's a lot of syllables. For the perp price, you take the perp minus spot, and if the spot is bigger as a number, you get negative number. So let's say if the perpetual future, the perp number price is, let's say, right now is what, 45 something. Make it 47. So let's say the perp price is 47 and the spot price is 46, right? Let's roll that back. Let's say the perp price is 46 and the spot price is 47. The basis would be negative 1,000. See that? If the spot price is bigger, you're going to have a negative number below this horizontal line, and it'll be white. And if the perp price is larger than the spot price, then it'll be a positive number, which would be on the red area here. So when someone says the spot market is trading at a premium, that just means the spot price is larger than the perp price. Okay. So what do you do with all that information? You can see here, I'm just going to do a little section here. You can see here it's white and it's below that horizontal line. That means that the spot price is trading at a premium, meaning the spot price is larger than the perp price. What does that mean? That means that there's a lot of, it could mean that market investors or traders, market participants are shorting the perp price. Okay, they're shorting it, so that means it's going to force it to go lower. And spot's going to be trading at a premium. It's important to pay attention to that because if they keep shorting it, and open interest, for example, it goes high, potentially there could be a short squeeze, meaning that the price is going to be influenced or manipulated, forced up, so that the shorts would get liquidated. So when you see a pattern like this, eventually, and it's been trading since November, end of November, November 22nd, and so it's been the spot market's been trading at a premium. So eventually, price is going to go up to liquidate the shorts, and that's exactly what happened here. That's 2 months. It's really long time if you look in this time frame here. So spot market has been trading at a premium for 2 months. Eventually, price went up to liquidate some of those shorts, as you can see here. Okay, but what you also notice is like where the these red sections here, the little red sections, that indicates like very bullish move up. You can see that right there. This is where the perp future prices are trading at a premium, meaning that they're higher than the spot price, and you can see that they're going up right there. But eventually they're gonna flip because those longs, so these market participants are longing the perpetual futures market. They're long in it. Eventually, guess what's going to happen? They can get the market prices will get manipulated or encouraged, if you will, to be pushed the other way to liquidate the longs. So you have here the market's moving up and they're long in it right there. Eventually, guess what happened? It flipped to the other side. Okay, so same thing here. Here's the red section right here. It's moving up, price is moving up. They're longing, they're going long, meaning the perp prices will be higher than spot prices. Eventually, they're going to get liquidated. And guess what? Price drops. Right there. It drops into the this zone, whitish zone, where the spot price will be trading at a premium, meaning that it'll be larger or bigger than the perpetual futures. And eventually it flips back. So you can go through and see this. This goes back to roughly around 2000, March 2020. Yep, March 2020. So you can see that there's a pattern there. So that's how you use this spot to a derivatives basis delta indicator to help you anticipate the upcoming prices or the cycles, bullish or bearish markets for you. I hope that was clear. I know it's a lot of terms. If you're new to this, it could be confusing. But if you get lost, just look at the colors. You know, if it's up like this, eventually it's going to turn down. So especially when it tapers off, and if it's down like this, it's going to be bearish, but eventually it'll flip back up. So that might be a simpler way for you to understand it. All right. Hope that added value for you. If it did, smash the like, ring my bell, and hit subscribe. And also leave a comment, please. Appreciate it. Thanks. I'll see you in another video. Maybe tonight, for sure tomorrow. Peace.